Hello there everyone, today's video we're going to take a look at mitigating capital gains tax when you sell buy-to-let properties. So, what do we do? Well, normally when you sell buy-to-let property, assuming you are a higher rate taxpayer, you're going to pay capital gains tax at 28%, okay? But here's a way where you can get that rate of CGT right down. Let me explain. So, just assume in this case we've got a 100 grand gain on a BTL. Cost 150, sell it for 250, it's £100,000 gain. So normally, ignoring the annual exemption for capital gains tax, let's assume this individual has already used that on another gain. 28% as a higher rate taxpayer on resi property, you're looking at a 28 grand tax bill on that 100,000 gain. So how do we get that down? Well, one option is to reinvest that gain into something else. Now then, specifically, reinvest it into what's known as an SEIS, Seed Enterprise Investment Scheme. So this is basically a tax break brought in by the government where they encourage business angels to invest in riskier startups. And the quid pro quo for taking on that investment risk is that you can get some really good tax breaks. So specifically, what happens is that assuming that the individual here invests all of the gain, so the 100 grand gain, puts that 100 grand into this SEIS company, this new company, could be doing all sorts of stuff, a tech, fintech, whatever it is, but it's a new company, riskier. The government say, look, because you've had this gain over here and you've invested the proceeds, you've invested the gain into this new business that qualifies for SEIS, we're just going to wipe out half of your capital gains tax bill. So that's pretty damn good. I mean, that's not even deferring capital gain, that's wiping it out. So in this case, 50 grand of that gain disappears, goes straight away. So then the remaining 50 grand out of this 100 grand gain is deferred until the shares in this SEIS company are disposed of, which could be many, many years down the line. At that point, the capital gain, which was deferred, comes into play, but it will be at 20%, not 28%. You're changing the characteristic because capital gains tax on resi property, the government's got it in for landlords, high, 28%. But on shares, just regular shares, assuming we're not getting any business asset disposal relief or entrepreneurs relief, default position, 20%. So you're going from a 28% on one type of asset to a 20% on another type of asset, combined with the fact that half the gain is wiped out. This guy ends up with a capital gains tax bill, £10,000. So had he just sold the buy-to-let, coughed up the tax at that point, 28 grand tax bill, or invested it in SEIS for a few years, 10 grand. So more than halved the capital gains tax. Now, yes, this is risky because that's the whole point of getting these tax breaks to begin with, because it's a brand new startup company. But hey, listen, it could be the next big thing, who knows? And I ain't giving investment advice here, I'm just saying these are the tax rules, this is how it works. So if you are in that situation of getting rid of a buy-to-let for whatever reason, and you don't necessarily need the proceeds from that sale of buy-to-let for anything else particular, if you could do with maybe investing it in something else, have a think about SEIS and doing this, because it will reduce your capital gains tax bill. So just an overview there on a CGT mitigation and deferral strategy. If you like this video, please do subscribe, and as always, I'll see you soon.